So, this week we are going to take a look back at some of the concepts that we had studied very briefly in our previous discussions, but did not have time to go into details. So, we'll be filling in some of the blanks there. And we'll also be spending some time looking at things which are a bit advanced, and so things to look forward to in perhaps future courses. So we begin by looking at a formula that we had seen when we had finished our discussion of capital budgeting. Remember that the most advanced version of capital budgeting formula that we had seen involved uncertainty, and we had found that one way to look at the present value is to compute it as, for instance, the expected value at time 1 divided by 1 plus expected value of r. But we did not really go into very much details about how do you actually think about this cost of capital expectation of R, right? And now, given that we have studied a bit of portfolio theory, we are in a good position to come back and try and attempt to answer this question. So one way of thinking about how to think about this cost of capital is that you want to kind of like provide an enough expected return so that investors would actually want to have this asset or project in their portfolio, right? And whether the investors actually want to have the asset or this project in their portfolio actually depends on what are the investors opportunities that are available to them, right? So typically investors buy a little bit of a lot of assets, right? And we can think of portfolios as bundles of multiple assets, right? So the question is, how can we get this project into being a part of this investor's portfolio, right? Now, recall our lessons from portfolio choice theory. So there we understood that investors like reward and dislike risk, right? So one measure of reward that we have studied before is to think about the expected rate of return on the overall portfolio, right? So that is the measure that we have been thinking in terms of reward. Now, how do we go about thinking about risk? So again, if you recall our discussion of uncertainty, so what we thought about is that you can think of the standard deviation of the rate of return on the overall portfolio, and you can use that as a measure of the risk. Now, the problem is that we cannot directly just think about what is the standard deviation of the individual assets and use that to come up with a measure of the standard deviation of the overall portfolio, right? So this involves a bit more work, and this is what inspired us to think about diversification seriously. And the main idea, if you remember, was that if you mix different investments within a portfolio, that can actually reduce the impact of each one of these investments on the portfolio performance, right? So for example, suppose that you have got two different investment portfolios, such that if one investment component goes down, the other investment component goes up. So in that way, each of them may be individually risky, but they may act together to offset the risk associated with each of them, right? And so this is not just related to a negative correlation. So the idea is that whenever you've got imperfect correlation, that can actually help to reduce the overall portfolio risk. And hence, it's not enough to just look at the standard deviation of these underlying assets, right? So we also need to look at their covariance correlation structures. Okay, so what are the implications of this insight from a corporate finance perspective? So then what you want to understand is that what are the projects that the investors in the company would want the manager to invest from their behalf, right? So this is the most basic corporate finance problem. Now, we understand that from our previous discussion that investors like diversification, and hence a reasonable starting point is to assume that they are holding diversified portfolios. Now, the question is, you want to kind of like get the investors to also take up this project perhaps on their behalf, right? So it's very difficult to go and ask each investor that, okay, would you like to company to actually take up this project or not, right? So in order to make some headway in this analysis as a starting point, we are going to go ahead and assume that since investors like having diversified portfolios, perhaps they are going to actually kind of like portfolio invest their portfolio such that their total market portfolio is actually the relevant portfolio, right? So what this means is that when they are considering about how to allocate their assets, not including your project, they're already considering all the different investment opportunities that are available, and they are kind of like allocating their uh, project their funds in these different assets, right? So what's the implication of assuming that the investors' portfolios are actually the market portfolio? Well, it simplifies the analysis, right? So you don't anymore need to go and ask investors what they may or may not like. You're already starting out from assuming that you have got each investors who potentially have this wide set of investment opportunities available to them, and their portfolio is going to be a representative thing, right? So basically now you want to think about it from your perspective that, okay, should we take up the project, uh, and would the investors want to have this project to be added to their current portfolio, which is this market portfolio. Okay. So put it in this way, the question can be reframed much more simply. So when would investors want to give their money for an investment into the firm's project, given that they're already holding on to this broad overall stock market portfolio? That's the question, right? So again, we go back to these two criteria. Investors like projects that offer more reward. So if it increases the expected rate of return, that's what they would be very happy about. Now, this is fairly straightforward to see, right? So you can think about what's the average kind of like rate of return. Does it increase or not, right? So on that criteria, it's fairly easy. However, the second criteria is a bit more complicated, right? So here we need to think about they like projects which actually help them to reduce the risk. And we now understand that to mean that they like projects which help them diversify away some of the risks that are already there in the market portfolio so that the overall portfolio ends up being less risky. So this is a bit more complicated object, right? So let's think about it a bit more. So one thing which is perhaps a very obvious mistake to make is that you should not just go for the lowest risk project, right? And here we are not even talking about it from a expected return perspective, just from a risk reduction perspective. Why might we not want to give out for the lowest risk project? Because we don't care about the risk that is involved in an individual project. What we care about is that how does it actually contribute to the risk that is there in the portfolio, right? So you may have investors who are actually perhaps looking for projects which behave very differently from their other projects, right? So that the correlation, for instance, might be negative compared to the other portfolios that they're holding, right? So then the relevant question from a risk perspective to ask is that how can one's project help one's investors to diversify, right? And is there some way of measuring how good this diversification benefits incur to the investors from actually taking up a project? Now, in order to again make some progress in thinking about these questions, let's start out by observing some basic things, right? So first, recall that diversification would not work if two investment opportunities always move in the same direction. So suppose the correlation coefficient is 1, then putting in money in two of these assets would not actually work in terms of diversification, right? Of course, you have got the opposite case where if you have got two investment opportunities which always move in opposite directions, then we know that diversification works well, right? So what that tells you is that we need to think about a bit more inspired by this on the underlying cases. And perhaps the relevant thing to know for us is to know how the rate of return of the project actually changes with the rate of return of the market, right? Based on these two insights. We already understand that if they are perfectly correlated, then this will not work. If they are perfectly negatively correlated, then this will work. So what about the intermediate cases, right? That's what we need to think about. Okay. So we can actually plot the rate of return of the project versus the rate of the return in the market, right? So here, what you see is for two different stocks, stocks B and C, we are plotting what are the rates of return of these stocks versus the rate of return of the market, right? And you can see these 4 points here. These basically represent the 4 different outcomes that can happen, right? So you have got one outcome which is represented by this point. And this is the same state of the world, but now here we are looking at what's happening to stock C and M, right? So you can see that, for example, this and this point have the same rate of return for the market, but different rates of return for the stocks, right? Similarly, this and this are the same states of the world. This and this are the same states of the world, and this again are the same states of the world. So they have the same rate of return for the market in both the figures, obviously, because it's the same state of the world. So that is determined in the the rate of return is the same, right? However, the stocks have different rates of return, right? And based on this, you can actually also think about, okay, how together are the rates of return for stock B, let us say, is moving with the rate of return in the market, and how together is the rate of return for asset C moving versus the rate of return of the market. So you've got these 4 points. So one way of kind of thinking about how are these associated these changes, you can actually draw a regression line, right? And that's what we do in both of these cases. And the slope of the regression line is what is known as the market beta, right? So we can see that for stock B, this is something which is positive, whereas for stock C, this is something that is negative. So let's think about the significance of these findings. So firstly, what does market beta of a project measure? Well, it measures how the project covariates with the market, right? So if the project has a negative beta with respect to the market, it means that it tends to go up on average when the market goes down, and it tends to go down when the market goes up. So for example, if you look at this thing here, you can see that as the rate of return of the market is going up, you can see that on average, this means that the rate of return of asset C is actually kind of lower, right? So this would be a case which is corresponding to slope being negative or the market beta being negative for stock C or asset C. Okay. If a project has positive beta with respect to the market, then it means that the rates of return tend to go up on average when the market goes up and tend to go down when the market goes down. So you can see that happening here for asset B, that the rates of return are typically higher if the rate of return of the market is higher. And we can also see this in terms of the number that if you calculate the slope of the regression line, that's equal to 0.64, right? So the market beta is something which is positive. Okay, so this is basically a measure that we are going to think of a investment's risk contribution for an investor who holds the market portfolio. Lower the market beta, better is it in terms of reducing risk, because basically, for instance, here, if you think about it, if the market is going down, this is exactly when the rate of return of this asset is going to go up. And so at least it will help to protect you against some of the losses happening on the market portfolio. Whereas here, if the market return is going down, that will actually also result in the rate of return of B also going down, and that will actually amplify the losses that you are suffering, right? So what is the implication of all of this? It means that holding everything else constant, right? Other characteristics such as the expected rate of return and so on, the risk-averse investors would prefer to pay more for assets that have lower market betas, right? So that's one finding. Okay. Now, at this point, there may be some confusion about, okay, do investors care about beta or standard deviation? And so therefore, from a corporate finance perspective, should a project manager care about the beta or the standard deviation, or are these all the same? Well, let's think about it one by one. So remember that from an investor's perspective, what you have is that the measure of the risk of this portfolio is the standard deviation, right? So investors care about the portfolio standard deviation, right? But they do not care about the necessarily the risks associated with the standard deviation of these underlying assets, right? Now, they do not care about the overall market beta of the portfolio, because what they care about is the risk that is there in the portfolio. So they care about the standard deviation of the portfolio. On the other hand, why is then market beta important, or whose market beta is important? So this is basically the individual assets market beta is important. Why is that important? Because it helps them to construct this portfolio, right? So from a market beta perspective, they care about individual assets market beta, but not the overall portfolio's market beta. From a standard deviations perspective, they care about the overall assets, overall portfolio standard deviation, but not the standard deviation of the individual assets. Okay. What are the implications of this from the firm's perspective? Well, if the firm wants to make sure that its shares are going to be purchased by investors who want to hold the market portfolio, then what the firm should care about, the implication of all of this is that it should care about the market beta of these projects, right? So that's the implication. Okay, so how does one compute the beta? So we have already discussed this from a perspective of real data, right? So basically, you would want to kind of like plot this and then look at the slope. So if you recall your results from the regression analysis, basically the beta of f with respect to the market M is going to be the covariance of the variables that you have, this RM and let's say the stock was asset was F, so then RF, right? Divided by the variance of RM. Now, we are going to see an alternative derivation of this later on this week, which does not rely on the regression analysis, but you can also kind of like take this to be the definition. Okay. All right. One can also ask that, okay, if this is the beta of a particular asset or a stock, what's the average beta of a stock in the whole economy? Well, that is basically asking what's the beta of this market portfolio. And that's the weighted average of the betas, the individual betas, right? Where the weights are the market cap weight of each stock. So you can do the calculations and the analysis, but basically this will turn out to be, if you kind of like use this formula directly also. So beta M is covariance RM divided by variance RM, but covariance RM is just variance RM. So therefore beta M will be equal to 1. You can also do the same analysis using the definition of WI, which is stated here, and then multiply that by beta I, so that is covariance RI RM by variance M, and do a lot of like algebraic manipulations and get that result. So we'll see one variation of this derivation later on, but for now, probably the most direct way of seeing this is just to kind of like put in f equal to m and then see that beta m will be equal to. Okay, so what are the uses of this market beta? So for instance, it provides a measure of the degree to which the firm's value tends to change if the stock market changes. So suppose that you have a company Y which has a market beta of 2. So if you have the stock market giving a extra return of 10% above its expected value, then the company Y stock on average will likely to return 20% above the company Y's expectation, right? So one thing to note here is that beta is only a measure of market risk and does not capture non-market risk, right? So it basically tells you that, okay, if the stock market changes, then how much would you expect the company's stock to change, right? But it does not tell you if other things change holding fixed the stock market, how would the stock return of this company-wide stock change, right? So that's one thing to keep in mind. Okay. Uh, then you've got that. Suppose let's think of the implication of this statement. Suppose that the expected rate of return on the market is 5% and the expected rate of return on company-wise 12%. Okay. Now, suppose the market returns a rate of 2%, right? So that is 3% below what the expected rate of return on the market was. Then having a market beta of 2 would imply that this company is expected to have a rate of return of 6%, right? Why is that the case? Well, this is 3% below, right? So beta of 2 multiplied by 3% means 6% below this 12%, right? So that's basically what we meant. For example, when we see that company Y has a market beta of 2. Similarly, if a market returns a rate of return of 10%, so that is 5% more than the expected rate of return, then having a beta of 2 would mean that the rate of return on Y, we can expect it to be 22%, which is 10% more. Why 10%? Because you have got this has 5% more. Beta of 2 means 10%, and 12% plus 10% gives you the 22%, right? So holding more stocks of company Y would actually tend to increase the effect of market swings, right? We can see here. So if the market is falling compared to what its expectation is, we would have that company Y would also have a lower rate of return compared to what its expectation is. But if the market returns a rate of return which is higher than what the expectation was, we would expect that company Y would also do the same, right? So in this sense, it is amplifying the swings. Okay, so one thing to note is that beta does not tell us on its own whether company Y is priced too low or too high on average. And so therefore, it is not a measure of how good an investment this is, right? So one also needs some information about the expected rate of return. And we'll see later on when we discuss, for instance, capital asset pricing model, about how one can incorporate that in the analysis, right? So what beta does is it's just a measure of how adding a little of the company stock increases or decreases the overall portfolio risk that we have in mind. Okay, let's look at some more applications of this concept of beta. So one can also think about how to uh, later on think about how to value a firm. And so just to do some preliminary work. So think of the firm as a weighted investment portfolio of projects, right? So a firm consists of multiple portfolios or projects or divisions, and we can actually think about the relationship between the different divisions and the overall firm's performance, right? So suppose that you have got a firm KL, which consists of divisions K and L. Then the firm's rate of return is basically nothing but the weighted average of the rate of return of these two divisions, right? Where what the weights will be the relative values of the two divisions. The expected rate of return from here would be the weighted average return of the risk returns of division. So expected rate of return of the whole firm is the weighted average of the expected rate of return of the individual firms, where again the weights are the relative values of the two divisions. One can also show that the beta of a firm would be basically the weighted average of the betas of these two divisions, right? And while you can do this sort of linear operations on expected returns and on betas, uh, as we have discussed before, you cannot do similar linear operations on standard deviations and variances, right? You cannot just write down the standard deviation of the rate of return is the weighted average of the standard deviation of the rate of return, right? So you need to factor in covariance and all these things. Similarly, you cannot also do the same thing for variance. Okay. The other way of thinking about a firm is to think of a firm which consists of debt and equity, right? So suppose that you have a 500 lakh worth of firm which is financed by debt worth 100 lakh and equity worth 400 lakh. So if one owns all the debt and equity, therefore one would own the firm. Now, how should we think of the market beta? So we want to kind of like think about this kind of reasoning, but instead of applying it to two different divisions, we now want to apply it to two different ways in which the firm is financed, right? So the market beta of the whole firm would be the weighted average of the market beta of the equity and debt, where the weights are basically this debt value to firm value ratio and equity value to firm value. Okay, so let's consider this example that we have. Suppose that debt has a market beta of 0.5 and equity has a market beta of 2. Okay, so in that case, firm will have a market beta which is given by this expression. So how do we get this? Well, the firm was worth 500 lakh, out of which debt was around 100 lakh and equity was 400 lakh, right? So this ratio of debt value to firm value, that would be 1 by 5, right? Then this beta debt, we had information that that's 0.5. Equity value to firm value would be 400 by 500, so that's 4 by 5, and this beta equity was 2, right? So then if you do the calculation, you end up getting 1 by 5 into 0.5 plus 4 by 5 into 2, and that's equal to 1 by 7, right? So this 1.7, this amount that you got, that's actually nothing but the asset beta, right? So the beta of the asset or of the entire firm. And notice that this is not the same thing as this equity beta that you have, right? So this is something to keep in mind, because often if you go to financial websites, so let's say if you go to Yahoo Finance, for example, you would see that companies often are going to have basically this next to each company you will see the value of the beta, right? So there, what they are often talking about is the equity beta, right, rather than the beta of the asset beta that we have talked about. So this is one thing to keep in mind whenever you see information listed about beta of something. You should figure out whether it's the equity beta or the asset beta that is there before you start using it for your analysis.